When you see a stock surge, 93.5% in just a few months, you really have to ask yourself, is it the ultimate undervalued rocket ship or just a brilliantly disguised value trap that's about to catch retail traders completely off guard?
Right. And I mean, that is the central anxiety of this market right now. You see a parabolic curve on a chart, and your brain just sort of splits in two.
Yeah, totally.
Half of you is, paralyzed by the fear of missing out on generational wealth, and then the other half is absolutely terrified that you're buying the absolute top just before the floor caves in.
Exactly, and we are aiming straight at the center of that anxiety today. Our deep dive is focused on Nebius Group. They trade under the ticker symbol NBIS.
Which has just been wild lately.
Oh, it's insane. They are aggressively positioning themselves as a pure-play AI infrastructure giant. And the mission for our analysis today is to, well, parse through this mountain of fresh market data.
Because there's a ton of it.
So much data, plus some fiercely conflicting analyst ratings and the kind of complex financials that, honestly, give accountants a headache. We need to figure out exactly what is driving this explosive stock.
And the volatility we are seeing here is historic. Like, to really grasp the velocity of this company's market movement over the last year, you just have to look at the sheer scale of the ground they've covered.
Right. If we pull back to their 52-week range, the low was sitting way down at $20.25.
Barely $20.
Yeah. And today, as of April 15th, 2026, it is trading at $166.77.
Which is just a staggering climb.
It is an entirely different universe for a stock to occupy in just 12 months. Okay, let's unpack this. Before we tear into the actual business model, we need to establish the battleground as it stands today.
Right.
Because there's a very bizarre tug-of-war happening behind the scenes.
Yeah, you have the public-facing momentum, like what the charts and the analysts are screaming, and then you have the internal mechanics of who is actually buying and selling.
And right now, those two indicators are pushing in completely opposite directions.
Exactly. They're fighting each other.
Let's start with the momentum, because it is undeniably aggressively bullish. I mean, the latest price of $166.77, it's sitting a fraction of a penny away from its all-time high of $166.81.
Basically right at the ceiling.
Yeah. It is up 33.4% in the last month alone. And, we aren't talking about some thin, easily manipulated microcap stock here.
No, not at all. The liquidity here is massive. You're seeing an average daily volume of 16.57 million shares changing hands.
Which is huge.
It is, which tells us a critical piece of the puzzle, right? The entire market has arrived. When you have nearly 17 million shares trading daily, you are witnessing heavy institutional involvement.
Because retail traders alone can't sustain that.
Exactly. Retail traders cannot sustain that kind of volume at $160 price point. This is big money taking positions.
And Wall Street is certainly cheering them on. The analyst consensus is overwhelmingly positive. We're looking at 9 strong buy ratings, 1 buy, 4 holds, and literally 0 sells.
Wow. Zero.
Northland just set a price target of $211, and Goldman Sachs bumped theirs to $205.
Which is a huge premium.
Yeah, the average target is hanging right around $162 to $170, meaning the stock is currently trading right at or slightly above that consensus average.
But, we have to look past the external cheerleading here. Analysts issuing strong buys often have institutional biases.
Or investment banking relationships to protect, right?
Exactly. The true story is always found by looking at what the insiders, like the people who actually run the company, are doing with their own money.
Which brings us to the contradiction. When you look inside Nebius, the narrative completely flips. We are seeing heavy insider selling right now in April 2026.
Yeah, the data on this is striking.
It really is. The CEO, Arkady Veloz, just sold $3.46 million worth of stock at 103.73 cents. And director Elena Bunina sold $3.0 million at prices scaling all the way up to 161.22 cents.
Millions of dollars just taken off the table.
Wait, if the Wall Street consensus says this thing is rocketing past $200, why on earth are the CEO and a prominent director hitting the sell button right now? Is this a glaring red flag for the retail traders who are buying their shares?
What's fascinating here is the interplay between that insider selling and the institutional volume we just talked about.
Okay, how so?
Well, on the surface, watching your CEO dump over $3 million in shares feels like a blaring siren.
Oh, absolutely.
But we have to weigh the context of insider profit-taking against the mechanics of institutional accumulation.
But a sale is a sale, right? I mean, it means they want cash more than they want the stock.
Sure, but insiders sell for a multitude of reasons that has nothing to do with the company's outlook. They buy real estate, they diversify their concentrated portfolios, or they have massive tax bills to pay on their vested options.
That makes sense.
Right. After a 93% run, taking some chips off the table is just standard personal finance. But the key metric isn't just that they sold. It's who bought those shares.
Ah, okay.
The data shows significant institutional accumulation happening right around the $149.82 breakout level.
Meaning the big funds, like the smart money, were actually stepping in and scooping up massive blocks of shares right below $150.
Precisely. When a stock breaks through a major psychological and technical resistance level, like it did around $150,
Yeah.
and you see volumes spike without the price collapsing, that implies large institutions are absorbing those sell orders.
Oh, I see.
They aren't scared off by the CEO selling a fraction of his holdings. They are looking at the fundamental business model and deciding Nebius is a required holding for their portfolios.
So to figure out who is actually holding the winning hand here, the buying institutions or the selling insiders, we have to look directly at Nebius's financial health over the last year.
We have to look at the actual numbers.
Exactly. How are they actually making their money? We have the full breakdown for fiscal year 2025 compared to 2024, and the shift is just dramatic.
It really is. The turnaround in their core metrics is what forced Wall Street to completely reevaluate the company's multiples.
So in fiscal year 2024, they brought in $117.5 million in total revenue. But in 2025, that top line number hit $529.8 million.
Which is massive.
That is a 351% increase. But the real shocker is the bottom line. They flipped from a brutal $641.4 million net loss in 2024.
A huge loss.
Yeah, to a $101.7 million net profit in 2025.
That is a nearly $750 million swing in profitability in a single year.
Just incredible.
Right. And to understand how they did that, you have to look at the mechanics of AI infrastructure. Nebius isn't building consumer chatbots. They are leasing raw compute power and server racks to the companies that do.
Ah, the picks and shovels.
Exactly. Once a data center goes live and the servers are spinning, the marginal cost to lease that compute power is relatively low. Hitting $100 million in profit proves that their core operations, the actual leasing of the hardware, has incredibly strong, sustainable margins once utilization reaches a certain threshold.
And that utilization is accelerating right now. I mean, Q4 2025 alone saw $227.7 million in revenue. That's a 547% year-over-year increase for that specific quarter.
There's massive acceleration.
But, that's only half the story. If we look at what it takes to generate that kind of revenue, the liabilities are staggering. Total assets ballooned by 250% to $12.45 billion.
Yeah.
But their total liabilities skyrocketed from practically nothing like $729 billion all the way up to $7.84 billion.
Because they are leveraging the balance sheet to the absolute maximum to fund their physical expansion.
Right, which bleeds directly into their cash flow. Their adjusted EBITDA improved by 71%, though it's still technically negative at negative $64.9 million.
Still in the red.
Yeah. But the free cash flow burn rate is what really caught my eye. It is terrifying. They burned through $3.61 billion in free cash flow compared to burning $1.26 billion the previous year.
That's intense.
The cash burn nearly tripled. It sounds like a lottery winner who just bought a $12 billion mansion and secured a high-paying job, but they are maxing out their credit cards just to pay for the electricity. The growth is there, but that cash burn is intense.
That is the reality of the sector, though. You cannot build a massive AI ecosystem incrementally.
You just have to go all in.
Exactly. You are purchasing tens of thousands of specialized GPUs, securing massive tracts of land for data centers, laying miles of dark fiber optic cables,
Right.
and most importantly, securing power contracts. All of that requires billions in upfront capital before it generates a single dollar of free cash flow.
Building AI infrastructure sounds a lot like laying the Transcontinental Railroad. You have to spend billions blasting through mountains, building bridges, and laying steel for years before a single paying passenger ever buys a train ticket.
That's a great analogy.
You are hemorrhaging cash to build the tracks, but once the tracks are laid, you basically own the monopoly on the route.
That is a perfect way to look at it. The $101 million net profit shows that the trains currently running on their existing tracks are highly profitable.
Right.
But the $3.6 billion in cash burn shows they were desperately trying to build more tracks across the country before their competitors do.
And that massive cash burn directly fuels the most polarized debate among analysts right now. Is Nebius profoundly overvalued, or is it actually undervalued based on its future dominance of those railroad tracks?
And the gap between the bull and the bear case here is just a chasm. It all comes down to how you value a company that is spending money faster than it makes it.
Okay, let's lay out the bear case first. The argument that this stock is just a brilliantly disguised trap. Right now, Nebius trades at a dizzying 415x price-to-earnings ratio and an 11.8x price-to-sales ratio.
Those are nosebleed numbers.
Totally. To put that 415x PE into perspective for a second, if you bought the entire company today and their profit stayed exactly the same, it would take 415 years for the company to pay you back in earnings.
Wow, 4 centuries.
Yeah. Based strictly on their current cash flow, traditional value models calculate a fair stock price at just $45.62, and we are trading at $166.
From a strict traditional value investing standpoint, it looks completely detached from reality. Paying a 415 multiple means you are paying an astronomical premium for absolute perfection in their future execution.
And the bears point out that perfection is pretty unlikely. Nebius has previously had to revise their revenue guidance because of operational bottlenecks.
Exactly.
But the real danger, the reason retail traders get wiped out in these scenarios, is that $3.6 billion cash burn. Nebius has a massive planned $20 billion capital expenditure spend coming up to build out their network.
Which is a huge hurdle.
It is. The bear argument is simple. To fund that $20 billion, they can't just take out loans at today's interest rates. They're going to have to issue millions of new shares of stock.
Shareholder dilution. The silent portfolio killer.
Yes. Explain the mechanics of that, because that is the trap.
So imagine the company is a pizza cut into 8 slices, and you own 1 slice.
Okay, I like pizza.
Right, who doesn't? So the company suddenly needs billions in cash, so they issue 8 new slices of pizza and sell them to the market. The company got its cash, but your slice just got cut in half in terms of its percentage of the whole pie.
Right, your piece of the pie shrinks.
Exactly. In hyper-growth tech, retail traders often buy the momentum. The company issues millions of new shares at that high price to raise cash, the float increases, and the stock price plummets under the weight of the new supply. You buy the dream, but you get diluted into a nightmare.
But the bulls are looking at a completely different timeline. The undervalued argument relies on discounted cash flow models projecting out to the year 2030, which suggest an intrinsic value for the stock of $627.77.
Nearly 4 times its current all-time high.
Yeah, and they base that $627 target on 2 massive catalysts. First, Nebius just secured a $27 billion deal with Meta.
That's massive.
It is. That gives them unparalleled revenue visibility all the way through the end of the decade. Second, they are planning capacity expansion to deliver 1 gigawatt of power by the end of 2026. Here's where it gets really interesting. I have to push back on this.
Okay, go for it.
Isn't betting on 2030 cash flows for an AI hardware company incredibly dangerous? It's like trying to predict what smartphone we'd be using 10 years ago. Technology shifts every 4 months right now. Can we really trust a $627 target based on hardware that might be obsolete in 3 years?
If we connect this to the bigger picture, your skepticism is entirely warranted. Modeling cash flows 4 years out in the semiconductor and AI space is usually an exercise in extreme, almost reckless optimism.
Right, it's just guessing at that point.
Mostly, yes.
Yeah.
However, the $27 billion Meta deal changes the math. It acts as an anchor that makes those 2030 projections mathematically credible, regardless of hardware shifts.
Because they aren't just projecting demand, they actually have a signed contract for it.
Exactly. When you lock in a giant like Meta, you have guaranteed baseline cash flow. Meta is on the hook to pay them whether the underlying GPU architecture changes or not. That contract is the bedrock of the bull case.
Makes sense.
But your point about the 1 gigawatt of power is where the rubber meets the road. Delivering 1 gigawatt is a monumental physical and geopolitical challenge.
What does 1 gigawatt actually mean in practical terms, like for a layman?
It is roughly the amount of electricity required to power a medium-sized city of about 750,000 homes.
Wow.
Yeah. Securing that isn't just about buying servers. It requires negotiating with local governments, building massive electrical substations, and navigating grid regulations.
That's a lot of red tape.
It is a massive physical moat. If they pull it off, their competitors simply won't be able to find the electricity to compete with them. But to build that infrastructure, they need that $20 billion in CAPEX. If they stumble on the logistics, they will have to dilute shareholders to keep the lights on.
So the Meta deal is the rocket fuel, but The threat of dilution to fund that 1 gigawatt power goal is the trap hovering over every investor.
Presley.
So 2030 looks promising on paper, assuming perfect execution. But retail traders aren't trading the year 2030 today. They are trading the chart in front of them right now. And if we transition to the immediate technical analysis, that chart is showing some serious stress.
It really is.
What are the signals telling the active trader who is looking at their screen right now?
The technical indicators are flashing bright, contrasting colors. We have incredible strength masking underlying exhaustion.
Okay, let's decipher the momentum first. The MACD, the moving average convergence divergence, is sitting at 6.48, maintaining a strong positive crossover.
Which is very strong.
Yeah, and for anyone unfamiliar, the MACD basically measures the relationship between two moving averages of a stock's price to gauge trend strength. A strong positive number means the short-term momentum is aggressively outpacing the long-term average.
The stock is flying way above its standard baselines.
Exactly. The 50-day moving average is all the way down at $107.39. The 200-day moving average is at $92.75. We are trading at $166.
Yeah, when a price detaches that violently from its 50-day and 200-day moving averages, it confirms that buyers have been in absolute uncompromising control. The trend is undeniably your friend if you bought in a month ago.
But gravity has to kick in eventually, right? And we are hitting a major ceiling. The immediate resistance is that all-time high of $166.81. We are basically tapping on the glass ceiling right now.
Tapping hard.
If it breaks through, the structural targets are up at $180 to $192. But if the buyers exhaust themselves, the strong support levels are way down. We are talking about a drop to $136.18, which was a former resistance level. And below that, the trend line completely breaks at $97.88.
That is an incredibly steep cliff to fall off if the $136 support level fails to hold.
Which brings us to the flashing red warning light. The RSI, the Relative Strength Index, is currently sitting between 72.68 and 76.42.
Yeah, that's high.
Explain the mechanics of the RSI and why a number over 70 should make buyers nervous.
So the RSI is essentially the engine temperature gauge of a stock. It measures the speed and magnitude of recent price changes to evaluate if a stock is overvalued or undervalued in the immediate short term.
And it runs on a scale from 0 to 100, right?
Exactly. Generally, an RSI over 70 strictly signals overbought conditions. It means the buying frenzy has mathematically outpaced the stock's natural momentum.
So buying right now is like slamming on the gas pedal when the engine is already overheating.
It doesn't mean the engine is guaranteed to explode. I mean, the stock doesn't have to crash.
Right.
But it heavily suggests that a period of cooling off or a sudden pullback is highly probable. The chart is screaming for a moment of consolidation.
So we have a massive divergence between the short-term reality and the long-term outlook.
Absolutely.
In the short term, the data suggests days or weeks of potential pullback simply because of this vertical move and that overbought RSI. The engine needs to cool.
Yep, take a breather.
But in the medium to long term, it remains incredibly bullish, with one major caveat. They have to hit their $7 billion to $9 billion annual recurring revenue target by the end of 2026. So what does this all mean for you listening right now?
It's the big question.
If you're staring at the chart right now, you're looking at a stock that is pressing against its absolute all-time high ceiling, while the RSI is warning you the momentum is running dangerously hot.
The technicals suggest extreme patience. Buying a stock right at its all-time high resistance when the RSI is over 76 is a high-risk, aggressive maneuver.
You're really rolling the dice.
You are betting that the stock has enough fundamental power to shatter the ceiling without catching its breath.
And we are about to find out exactly how much fundamental power they have. The timing here is crucial. The very next catalyst for Nebius is their earnings report, which is estimated for April 29th, 2026.
That is just around the corner.
Right. That single report is going to be the definitive event. It will determine if the stock smashes through $166 and heads toward $190, or if it exhausts itself and falls back down to test the $136 support.
It's the ultimate proving ground. They have to show the market that their massive $20 billion CAPEX plan is on track without threatening imminent shareholder dilution.
And they have to prove that the infrastructure for the Meta deal is actively being built.
Everything hinges on the fine print in that April 29th release.
Which brings us to the summary of our deep dive today. Nebius Group is an AI infrastructure powerhouse boasting a massive 351% revenue jump, a $101 million pivot to profitability, and a staggering $27 billion anchor deal with Meta.
Incredible numbers.
But with an astronomical 415x PE ratio, a multi-billion-dollar cash burn, heavy insider selling, and a technically overbought chart, the line between an undervalued opportunity and a retail value trap is razor thin.
It is a textbook case of generational potential weighed against severe, immediate execution risk.
Now, we want to hear from you. Make sure you like the video, subscribe to our YouTube channel, and it is compulsory that you leave a comment with your feedback. Are you siding with the institutions who are aggressively buying the breakout, or are you siding with the company insiders who are quietly taking their profits and running?
This raises an important question to consider before that earnings call. We've talked extensively about Nebius laying the railroad tracks for the AI boom.
Right.
They provide the power and the servers that make the revolution possible.
But if Nebius is spending $20 billion to build the tracks, what happens if giants like Meta, who have nearly unlimited capital, decide the margins are too good to share?
Yeah, what if they just start building their own infrastructure before 2030?
Will Nebius be left holding a $20 billion bag with no trains running on their network?
It is a fascinating structural risk to ponder as we wait for those numbers to drop.
It really is. Keep your eyes glued to that April 29th earnings report. It is going to be a wild ride. Thank you for diving deep with us today, and we'll catch you on the next one.